The numbers do not lie. The policy is not speculation. And as of Thursday morning, the global silver market will operate under an entirely new paradigm. Silver is trading at $75.90 per troy ounce as I record this broadcast. That represents a gain of 4.60% in a single trading session. Since the beginning of 2026, just days ago, silver has already risen 6.78%. The gold to silver ratio has dropped from 59.70 to 58.35, indicating that silver is outperforming gold on a relative basis. And a senior commodities analyst has just issued a warning that should make every investor pay attention. Anton Kharitonov has stated publicly that if China applies its new export rules strictly, we could easily see a 30% rise in global silver prices over the next 12 months. 30%. From current levels of $75, that projection puts silver at approximately $98 per ounce by the end of 2026. We are talking about triple-digit silver becoming a realistic probability, not a fantasy. We are talking about a structural repricing of one of the most important industrial metals on the planet, and we are talking about it happening in real time, starting Thursday. Let me explain exactly what is changing because the details matter enormously. Starting Thursday, China is implementing a special 2-year licensing regime on silver exports. This replaces a quota system that had been in place for more than 2 decades. Under the old system, Chinese companies could export silver up to their allocated quota with relative ease. Under the new system, every single export shipment requires explicit government approval. Every company that wants to export silver must apply for and receive a license from Beijing. And the eligibility requirements are severe. Companies must demonstrate proven export history. They must meet high production thresholds. They must satisfy bureaucratic criteria that most smaller firms cannot possibly achieve. The result is a dramatic narrowing of the pool of approved exporters. How narrow? Only 44 companies have qualified for export approval for the 2026-2027 period. 44 companies, in a nation with millions of businesses, in a country that processes and refines a massive share of the world's silver supply. Only 44 entities are now authorized to ship silver outside of China. This concentration of export authority gives Beijing near total control over who receives Chinese silver and who does not. They can reward allies, they can punish adversaries, they can prioritize domestic consumption over foreign customers, they can create artificial scarcity to drive up prices, and based on what we are already seeing in the physical market, that is exactly what is happening. The Shanghai Premium tells the story. Silver is currently trading $5 to $10 per ounce above Comex prices on the Shanghai Futures Exchange. Let me translate that for you. Chinese buyers are paying $75 to $80 for silver that the paper market in New York says should cost $70 to $75. That is a 10 to 15% premium over the international benchmark. That premium exists because Chinese industrial users, the solar manufacturers, the electronics companies, the battery producers, are desperate to secure physical metal before the export restrictions tighten further. They understand that the supply inside China is about to become significantly more valuable than the supply outside China. They're willing to pay whatever it takes to get metal in their hands. Joseph Darrier of Tickmill has analyzed the situation and reached a sobering conclusion. He noted that the limited number of approved exporters adds friction to the system and concentrates supply control in very few hands. This could increase silver availability inside China while dramatically tightening supply abroad. The United States, Europe, Japan, South Korea, India, all the major silver importing nations will find themselves competing for a shrinking pool of available metal. The price must rise to ration that supply. There is no other mechanism. There is no alternative source that can fill the gap. China dominates silver, refining the way OPEC dominates oil production. And they have just decided to turn the valve. Anton Kharitonov's 30% price projection is not hyperbole. It is based on the mathematics of constrained exports meeting surging industrial demand. He stated explicitly that silver is becoming one of the most geopolitically sensitive metals in the market. He said this is no longer just a precious metal rally. Silver is being repriced as a strategic industrial asset heading into 2026. Those words should echo in your mind every time you look at the price chart. This is not speculation. This is not a bubble. This is a fundamental repricing of a scarce resource that the world cannot function without. The industrial demand picture makes the supply constraints even more explosive. Solar panel installations are accelerating globally. Every photovoltaic cell requires silver paste. The International Energy Agency projects that solar capacity will triple by 2030. Electric vehicle production is ramping up as governments mandate the transition away from internal combustion engines. Every EV uses more silver than a traditional car. AI infrastructure is being built at unprecedented rates. Every data center, every server, every connection requires silver because silver has the highest electrical conductivity of any metal. More than copper, more than gold. There's no substitute for silver in these applications. The demand is non-negotiable, and the supply is now controlled by Beijing. The United States government understands the strategic implications. In November, Washington added silver to its critical minerals list. This designation recognizes that silver is essential for national security. It is essential for the electrical grid. It is essential for the defense industry. It is essential for the technologies that will define the 21st century economy. But adding silver to a list does not create new supply. The United States produces very little silver domestically. American industries depend on imports, and those imports increasingly flow through a Chinese bottleneck that Beijing can tighten at will. Elon Musk has been vocal about the threat. He publicly criticized the Chinese restrictions, warning that silver is essential for many industrial processes. Tesla needs silver for every vehicle it produces. Tesla needs silver for every solar panel it installs. Tesla needs silver for every Powerwall battery unit. When the CEO of one of the world's most valuable companies takes time to criticize Chinese trade policy, the situation is serious. Musk understands that his supply chain is at risk. He understands that Beijing has leverage over his entire business model. He is sounding the alarm because the threat is real. Alicia Garcia Herrero, a prominent economist, has argued that the policy is designed to prioritize China's domestic solar and EV sectors even if it strains foreign supply chains. This interpretation makes perfect sense. China is the world's largest manufacturer of solar panels. They produce over 80% of global supply. Every solar panel requires silver. By restricting silver exports, China ensures that its own solar industry has priority access to the metal. Foreign competitors must scramble for whatever is left over. This is industrial policy weaponized. This is resource nationalism in action. This is the new normal. The timing of the restrictions is particularly significant. They arrive after a year of extreme volatility during which silver briefly surged above $80 an ounce. Many observers viewed that spike as speculative froth. But the policy changes reveal something deeper. Beijing is treating silver as a structural strategic asset, not a speculative commodity. They are implementing multi-year licensing regimes. They are concentrating export authority. They are building systems designed to persist for decades, not months. This is not a temporary intervention. This is a permanent shift in how silver flows through the global economy. The gold to silver ratio provides additional confirmation of silver's relative strength. The ratio dropped from 59.70 on Friday to 58.35 on Monday. This means that silver is gaining value relative to gold. During precious metals bull markets, this ratio typically compresses as silver outperforms. The historical average is around 50 to 1. During previous secular bull markets, the ratio has fallen as low as 30 to 1. At 58 to 1, there is significant room for silver to continue outperforming gold. If the ratio returns to 40 to 1, while gold remains at current levels, silver would need to trade above $110 per ounce. If gold continues to rise as well, the silver target becomes even higher. Let me address the risks, because no investment is without risk. Potential U.S. tariffs on Chinese goods could disrupt trade flows and create volatility. A strong dollar, if it materializes, could create headwinds for commodities priced in dollars. Technological substitution, the development of alternatives to silver in certain applications, could reduce demand over the very long term. But these risks are manageable and uncertain, while the supply constraints are immediate and certain. The licensing regime goes into effect Thursday. The 44 approved exporters are already identified. The Shanghai Premium is already $5 to $10 above Comex. The reality is here. The risks are hypothetical. The broader outlook remains constructive according to every analyst I have reviewed. Kharitonov believes silver is entering a new pricing regime rather than experiencing a speculative spike. This distinction is critical. A speculative spike reverses. A new pricing regime persists. The factors driving silver higher are structural. They are not going away. The Chinese export restrictions will be in place for at least 2 years. The industrial demand from solar, EVs, and AI will grow for decades. The supply deficits will persist because new mines take 7 to 10 years to develop. The conditions for higher prices are locked in. If you own physical silver, hold it. The gains you have seen are just the beginning. The 4.60% move today is a taste of what is coming as the market digests the implications of China's policy shift. The analyst projections of 30% upside translate to nearly $100 silver. The Shanghai Premium confirms that the physical market is already pricing in scarcity. You are positioned correctly. Do not let short-term volatility shake you out. If you do not own silver, you need to start accumulating before Thursday. The licensing regime goes live in days. The supply constraints will tighten. The price will rise to reflect the new reality. Waiting for a dip is gambling that the structural forces will somehow reverse. They will not reverse. The 44 approved exporters are set. The Shanghai Premium is expanding. The industrial demand is insatiable. Every day you wait is a day you miss. Silver at $75 is not the peak. It is the new floor. The repricing has begun. The strategic industrial asset narrative is replacing the precious metal narrative. The geopolitical sensitivity is increasing. The supply is constrained. The demand is exploding. And the analyst projections point to 30% upside over the next 12 months. This is the moment. This is the opportunity. This is the structural shift that will define silver prices for years to come. Position yourself accordingly. Hold your metal, accumulate on any weakness, and never ever sell your physical for their paper. The licensing regime goes live Thursday. The repricing has begun. Act now.